I think it's one of the most powerful strategies in this business, or one of the reasons why we all do this.
There's a secret the rich and wealthy have been keeping that they use to exponentially grow their wealth. This philosophy doesn't ask the question, what is the return on investment, but rather, how long will it take for it to come back to you so you can reinvest? It's called the velocity of money. And today, alongside Brandon Jenkins, founder of Birch Prosper, who's invested in over 2,300 units, we're going to explain why this slight tweak in your investment philosophy can significantly amplify your approach.
A lot of people either overlook it, or they haven't heard enough about it, or they don't think it actually works. But once they see it in play, you can't unsee what you've seen.
Are you ready for an upgrade?
My first job was to work as a petroleum engineer, and more specifically, a drilling engineer. So I was in oil and gas for some time. And if anyone is familiar with the oil and gas business, then you know that it's a good one when it's good, but when the price drops, then they tend to show people the door. And so I witnessed that firsthand. I actually worked through three downturns. The second one had a material effect on me because although I was able to keep my job during that particular downturn, I really started to see the potential impact of employment risk, right, and not having enough streams of income to really insulate you against some of the downsides that we all face. I think this the reality of life. So one of my good buddies from college, we used to flip properties in a market that was outside of where I lived at the time. So I lived in Houston when I was a petroleum engineer. And so I went out and kind of checked out his operation. I really thought it was fascinating, but I wanted to kind of lean more toward predictability, cash flow, these kinds of things. So I started off as a single family investor, and I got to 12 properties, and then wanted to scale. So I wanted to scale up and take advantage of economies of scale and increase the velocity of my capital, all these good things. And so I stepped into the syndication space as a passive investor or a limited partner. And then fast forward to now, I'm now both a limited partner and an active partner, or a GP on deals. And so I have 2,900 units as of this past week. And so yeah, I would say that my superpower is probably resourcefulness, and maybe even curiosity. I really started to if something is of interest to me, I tend to chase it down, get all the facts, meet the right people, mentors, and that sort of thing to help me craft a plan, and then take action. I think that's maybe what sort of my origin story and my superpower, if I had to call it one. That's what it is.
And you mentioned you were in the oil and gas industry, and you also invested in single family rentals before you moved into the multifamily space. How has that concept of the velocity of money, which is going to be the central theme of today's topic and conversation, how has that played a role in your journey so far? And can you also define what the velocity of money is for our audience?
Yeah, the way that I like to think about it is, if you can find a way to essentially increase the magnitude or the impact that your capital has, there are many places to invest your capital, your hard-earned money. But if you can put it in an instrument where, in the same amount of time as another vehicle, you can get significantly higher returns, and particularly when there are things that are inherent to the vehicle that will allow you to capture a larger return in a short amount of time, much in the way that multifamily properties does. Okay, so if you think about, and even so, if you think about single family with one transaction, you get one door. Okay, and even if you go, if whether it's a duplex, a triplex, quadplex, you'll get one, two, three, four doors. Okay, with one transaction. But if you go to larger deals, for roughly the same amount of time, it might be 60 or 90 days for the actual settlement process and due diligence and all these things. But ultimately, for that one transaction, you now have 100 doors, 150, 250 doors. Okay. And so you are just taking advantage of economies of scale in that way, because your capital, first of all, is being multiplied. Your time is, you're cutting down on time significantly. I like to call real estate, it's almost like a time machine. It sort of gives you some time back. You multiply your time, the time you have in a day. We all say that we only have 24 hours in a day, but one way to significantly amplify or multiply that is to find a way to be able to sort of springboard your capital, or make better use of your capital, so that it's working harder for you than it would in another vehicle. So that's kind of how I summarize what I mean by the velocity of my capital is.
Yeah, and do you have anything to add about how that has sort of showed up along your journey so far?
Yeah, absolutely. So I can tell you that I was very surprised to find out just how um, uh, not tangible, but how real the results are, and how it's been for me. So one thing I'll share with you is, in the last role that I worked in, as a petroleum engineer. Okay, so I got laid off. It was with a company who, I enjoyed the company, enjoyed the people, so I don't have anything bad to say or anything like that. Um, but the company sold a major portion of their assets, and so I was laid off. Okay, so I took it took me about 2.5 years to find another role after that. At this point, I do this full time, but I found another gig. And during that time, it was, as you can imagine, a very difficult time because I applied to hundreds of jobs. Okay, um, and so I got real comfortable with rejection. I can tell you that. Um, but but yeah, so I was able to find a job eventually, and I was all upset. And I was, with my father at one point. I just had a conversation with him, and he said, "Well, hold on, Brandon, just let's stop for a moment, and I want you to take a look at the returns that you've gotten from these deals that you've been investing in." And I just, as simple as that sounds, this whole time, the whole time I was dealing with that, I really didn't think to do that. So I stopped and said, "Okay, let me just kind of take a look and summarize it." And long story short, long story long, it was it was a salary, and so I was able to, even during that period of uncertainty and sort of being in the thick of it, um, the deals and the capital that I put toward these syndication deals, it literally was able to pay me a salary. Okay, and so, now, granted, I reinvested a good portion of that, but that's the real impact that it's had on me. And so the light bulb was already on, but it really turned up, even more after that.
Yeah, something you mentioned earlier is that you navigated three downturns during the oil and gas while you were in that space. I wanted to know, how has real estate compared to that space in terms of stability and resilience when it comes to that velocity of money principle?
Yeah, real estate is definitely, a much more stable, industry sector. For one thing, you have a number of different asset classes in there that can even give you varying degrees of stability. Oil and gas. It's interesting though. You have private placement deals, private investments in the oil and gas space, similar to real estate, and it does have its advantages. So I know that's into the topic, but it does have its advantages. It is still, though, a very risky play. So it's not something you want to get involved in if you kind of, I don't know, if you don't have an awareness of what that business means. Really, I was going to say if you don't have a lot, like, if you need the money, so to speak, but I don't want to say that. It's an investment. Okay, so there are no guarantees, but I'll say that if you don't understand that business and the levers that an operator can pull to maximize the return, then that's something you have to be careful of. But I'll say that, the real estate space is far more stable. We're providing a fundamental need, which is something that I love. Even with with what's happening now in the marketplace, right? High interest rates, inflation. There's a lot. The transactional volume has slowed because the gap between the buyer and the seller is wide, and right. So all these things that are going on now, but we're still providing a fundamental need. Okay, and we still have a hard asset, and it still is something that, if you manage it properly and make it through this, that you'll be in a good position on the other side of this. So a downturn means something very different in real estate than it does, especially in commercial real estate, than it does in the oil and gas space, because, especially for multifamily, which is what I focus on, because in multifamily, you are providing a need. Okay, so you can still do something to, as long as you buy right, you can still do something to manage the property and make sure that it survives, as long as it's a healthy deal, and then come out on the other side of this, and your value will do what it was. I'm sorry, what it not what it was, but what it will. Right, the market, you make sure you maximize your NOI to juice up the value of the property. But in terms of the overall kind of investment, the investor appetite, and being able to leverage some of that upside, survive the downturn, and then you'll be in good shape on the other side.
Yeah, this velocity of capital concept, I think, can be confusing for some people. And I know you have a podcast called The Capital Stack. And so I imagine, and of course, you are in the multifamily syndication space. So I imagine you are educating investors. That's a big part of your
Mhm.
job. I wanted to know, are there any common misconceptions or misunderstandings that you find are very prevalent when it comes to that velocity of capital concept?
Yeah, I think that, one thing that I believe is a misconception is when people step into this arena, but they don't want to have any of their own capital in play. Now, here's the thing: are there ways to do that? Sure. Okay. I don't advise people to. Because I think that if nothing else, you need to have the mindset of this is my capital. And so I believe that when people go too far down the path of no money, I'm not going to put any money into it, then I think that you have a mindset shift. That's not true for everyone, but that's the risk that you might run into, is that you say, well, sure, I'm going to treat it with respect, but ultimately it's not my capital, so I didn't have anything to lose. So I believe in having skin in the game. I also believe that even from a practical standpoint, if if you have some capital to work with, then it becomes easier for you to execute. Now, but that's one thing that I would say is kind of a misconception. I understand where it comes from. I understand the spirit of it, and I don't mean to suggest that you have to be rich and wealthy before you can invest. But I'm saying that if you're going to be on the active side, there's a lot to consider. Risk capital is not something to scoff at. I've had plenty of people who have put up upfront capital in a deal, and especially when the transactional volume was a bit higher. So, like a few years ago, put capital into the deal, and it was during a period where uh, brokers and sellers were not really amenable or as amenable to certain contingencies. And so, in some cases, they might have lost out on that upfront capital, that risk capital. And so, if you don't, and that's basically what I'm getting at here, is if you don't, if you're someone that believes that you can get in with no capital, then stuff like that it can take you out of the game. So that's something I would say is kind of a misconception.
Yeah, I appreciate you sharing that. A certain facet I want to expand on for this whole velocity of capital principle is that a lot of times when you're focusing on that and that's your main priority, you're shifting the focus from how much a return you're going to receive on the investment to how soon you can receive the return on the investment, which is a key distinction.
Hmm.
And I think a big factor that determines what rate you'll get your capital back is the investment itself and the asset class. So I want to know, like, how do you determine which asset classes have a higher capital velocity? And is it like, I'm sure that there's subsets of multifamily assets. So can you expand on that a little bit?
Sure. So the way that I do it is to look at a metric called the internal rate of return. It's something that is a bit difficult. You can't calculate it by hand, right? But it is difficult to explain. I'll say that the short way of thinking about this is your internal rate of return, your IRR, tends to be higher the sooner you exit. Okay, just broadly speaking. Um, but when I'm comparing opportunities, then what I would do is to look at the internal rate of return across all of those opportunities. So it's a time bound metric. It gives you a sense of the real return based on a certain discount rate or an expected return, and it will tell you which of the projects that you're pursuing will give you the better return on your capital. Okay, so I mean, and a lot of businesses function this way as well when they're determining which project they're going to allocate capital to. Oil and gas actually does the same thing. They tend to look at, we could execute or commit capital to these projects and drill these wells and produce these fields, but what's the IRR? And so they'll come up with a priority based on that and some other factors. That's the way that I do it. So I tend to look at what's the internal rate of return on the project, but then also, you're going to want to factor in your risk appetite on top of that. I know there's no one number that's going to give you the answer, but if there was one, that would be the one.
That reminds me of, I think we already touched on this, but I want to highlight that difference between return on capital and return of capital. A
Hmm.
lot of investors, I definitely think that they're prioritizing the return on investment, but not necessarily the return of their investment. Can you maybe clarify the difference there?
Yeah, so I would say, simply put, if I have a deal and I'm a passive investor, I put 100K into the deal, and it's supposed to get me, the equity multiple or something like that is I don't know, 1.6x or something. So it's going to give me 60% return on top of my capital. Return on capital is the return of your initial principal. So that 100K that I put into the deal, that's the return of my capital. The return on capital is anything on top of that. So if it's an equity multiple, is basically what it sounds like. It's just the multiplier of your principal, your capital. And so if I put 100 in and the project actually carries out per the projections, and it's 1.8 or whatever number I just said, 1.6, 1.8. Let's say I'll go with 1.8. So if it's 1.8 equity multiple, then the total that I get is then 180,000 out of the project. So return of capital 100,000, which is what I put in my principal. Return on capital will be then that 80% or that 80,000.
Yeah, one of the points I think we're driving home is that achieving a return on your investment sooner allows you to reinvest it with to make even more passive income and to expand your wealth.
Yeah, I would agree with that, and to me that's important. There's some models where they call it the perpetuity model, which is something that it's been a while since I've seen a deal come through with that, but it's a really good one because what it allows passive investors to then do is to you get the return of your capital, and like you just mentioned, you can deploy that in another deal, and then you're still in some cases you're still in the deal, so that capital you're getting now what's called infinite returns, and it's returning capital or returns from the deal that you're in, and it's working for you. Meanwhile, you can take your principal and now put that in another deal. So yeah.
Yeah, I think what would be really helpful is if you could maybe provide an example, or if you have an example that you've done, or if you've heard of one regarding like, how that reinvestment process would work and the benefits of it to the investor.
Yeah. So I haven't personally have had a perpetuity model deal, but I've seen one. An example might be, if you're in an investment opportunity, a syndication deal, where the sponsorship team plans to, let's say it's a 5-year hold or something like that, and the sponsorship team plans to refinance at year 3. Okay, so they'll do a refinance, a cash out refinance. They'll return the principal or the initial investment to their investors. In some instances, it might not be a full 100%, but for this conversation, we'll assume it is 100% of their original capital. Meanwhile, anything the return on their capital is still in the deal, and so it's still you're making money on your money at that point. And because they did a cash out refinance and return that capital then to the investors, now as a limited partner or as a passive investor, you can take that capital that you now have from the refinance, you can use that in another deal. And so any other capital that was earned in that time on top of your initial capital that you put into the deal, that's now going to stay with the deal. So distributions, that are still coming out of that property, they're going to go to you every month or every quarter or however the setup is.
I know Robert Kiyosaki in the past has always referred to the velocity of capital as the secret the wealthy use to grow their wealth and really expand it. So I think I'm so glad you're here to like really break this down because even we didn't really completely understand it when we first got into it. We started wholesaling houses and flips, and we're still doing single family on the side. But the whole reason we got into multifamily was because of that velocity of capital and really getting more bang for our buck, for lack of a better phrase.
Yeah, it's definitely a powerful tool that a lot of people either overlook it or they haven't heard enough about it or they don't think it actually works. But once they see it in play, most of the people who anyone who I know that has actually seen the benefits from that, including myself, um, then you can't unsee what you've seen. And so from then on, like I said, that the light switch it just kind of goes on, and I think it's one of the most powerful, really powerful strategies that we kind of have in this business. So one of the reasons why we all do this, is to increase the velocity of your capital, and it works.
Yeah, in traditional real estate investing, even like I would say mainstream mindset is to focus on long-term appreciation, and we're almost I was under the impression that like the value add approach to investing and the forced appreciation was a little bit more contrarian to that. But I've heard you in a previous interview say that your perspective on value add investing has changed, and there's a lot of investors out there that will kind of put it on the pedestal as the supreme investment strategy, specifically when it comes to multifamily. So I was really fascinated to know what is your perspective on value add? Is value add appropriate in every market? And I know you're going to
Mm.
probably talk about value preservation, but I want to hold off on that because that's the second question I want to follow up. So, yeah, what is your take on value add?
So my take on a value add deal is that under the right conditions, it makes sense. Okay, and so I like a value add deal if there is an imbalance in the market relative to the deal itself. Okay, so if I'm in a sub market where it's a B plus or an A in terms of the market itself, but there's a deal or a property that has been maybe poorly managed or whatever it is, and the property itself is like a B minus C plus. Then for me, that imbalance right there really makes it an attractive deal, because then you can capture some of that imbalance, that gap. So under those conditions, then value add deals make sense. I don't advise people to to seek out those types of opportunities if the imbalance is thin. So if you're in a deal where it's a C plus deal, or a property, and then it's a B minus market, then just generally speaking, it's a little bit thin, and so there's not much of a value add component to it. You can sort of pitch it as that, but the bottom line is there's not much upside, and so you can get yourself into some real trouble with that. Generally speaking, I think it works, but I think it works under a narrower set of circumstances than maybe in the past. People thought.
Yeah, I wanted to kind of expand on that a little bit. Do you find that more often than not, particularly right now in this environment, that balance is thinner than it maybe was in the past?
I would say right now, yes, is the short answer, and the reason being, we're seeing a cap rate expansion right now. Okay, and so value add deals work really well when you're seeing a compression of cap rates, the cap rates going down. And so because cap rates are expanding, it's a little bit difficult then to benefit from a true value add deal. I still think that there are deals in every market. You just have to buy it right, and those kinds of things. But I think with where we are right now in the marketplace, yeah, it's a little bit tough to find a deep value add that still makes sense.
Yeah.
So
And so to kind of like follow up with that, I know you're now focused on value preservation, and it's
mhm.
almost like maybe like the new wave, or maybe that was like the long philosophy that people have gone back to as it's a foundational philosophy when it comes to investing. But can you expand on why you're focused on value preservation right now, and maybe just define it for context?
Sure. So value preservation, really for me, it's a strategy where you focus on an asset class where you have fewer risks. That's actually what, if I had to summarize it, that's what it is. You're focusing on a higher quality deal. If you heard of the term flight to quality, basically that summarizes it as well. Value preservation means you're going after opportunities where you have inherently de-risked the deal. If it's a newer construction, then you're going to have less of a maintenance risk in the deal. If it's in an affluent area or an almost affluent area, you're going to have less risk in terms of vacancy risk, or whether or not the tenant base can actually afford the property. So you're going to have less risk in terms of the execution of your business plan. You have this, and generally speaking, as cap rates expand, that expansion will impact sort of your B class and C class a little bit more than it will in A class property. And so, as an investor, you preserve the value is therefore preserved in an A class deal in a newer property, because you don't feel that expansion. So the value to the asset itself is preserved over a longer period of time relative to a B class or a C class deal. Um, so for me, what it is, it's if you think about the cycles and the real estate market cycles, you do have to have a different strategy depending on where you are. I think that you can never really get locked into one and say this is my thing. I want to stick to it regardless of what the economy is doing. I think it's a bit wiser to say I'll adapt a little bit and I'll make some adjustments depending on what I'm seeing. And so I do think right now that's kind of the better play. Now, with where we sit today, there are deals that are trading well below intrinsic value. So you can starting to get people kind of chasing some of that as well, which that's okay. But I do think value preservation is something that, even from an investor sentiment standpoint, I think that that's something that is much more attractive right now.
This discussion on investment strategies and your approach, maybe how you're refining it or really honing in on certain aspects of it, ties in well with that conversation on the velocity of capital. In any investment strategy, one of the main core aspects of it is that business plan. And to even break it down further, the exit strategy and kind of like how you plan to exit the deal. Because how are you going to get that velocity of money if you're not exiting one deal to move into another? And that really leads into the next point I want to bring up is um, when it comes to that exit strategy, how are you ensuring that you're investing in deals that allow you to reinvest and maintain the momentum as you progress on that journey when it comes to that exit strategy?
With respect to the deal itself, so when you go into a deal, one of the things that a seller will do if they kind of know what they're doing is they'll leave a little bit of meat on the bone. They'll prove up the potential upside, and by prove up, I basically mean they'll renovate some of the interiors as an example to prove up that, hey, there's some additional upside. Then the property gets marketed, then you buy it. Because you realize that there's some more upside, that and some other things. So similarly, when we exit deals, what we look for is, okay, listen, we want to leave some quote unquote meat on the bone here. We don't want to. So if you don't want to be, that's why you don't want to be at the top of the market. Most people, when they project their revenues to the property, they're going to aim for something that is not being the top, property in that submarket, because then there's less of a reason or rationale for a buyer to then focus on that deal, unless it's like an institutional buyer or something like that. So from with respect to the deal, that's kind of how we position ourselves. Is we'll say, okay, well, I want to make sure that we prove up a certain number, a certain percentage of the units to say that there's some more upside here, so that the next buyer, a next buyer analysis will bear this as well, and so they'll show that, okay, here's the upside then to that buyer. So you have to sweeten the deal for the next person to come along and say this is a good deal. Otherwise it's hard for them to really justify uh, buying it from you.
Something that we keep touching on is how, like, when it comes to the velocity of capital, investors want their money fast. I mean, that's one of the factors they're looking at, is how fast they get their money back. And
Yeah.
I imagine that can lead a lot of people to make aggressive or speculative or just risky assumptions and investment decisions. And so that leads me to, I guess, the next point I wanted to touch on is, how are you mitigating risk? How do you mitigate risk? But also, how do you advise others and your investors that you work with to mitigate risk, but also make sure that they're pursuing that velocity of capital? How are they safeguarding against the risks, particularly in an environment like this that we're seeing right now with all the uncertainty we're facing?
Yeah, yeah. One of the things that, so I usually, as much information as I like to give, I do try to caution people from going too deep into the weeds in terms of metrics, because I'm an engineer, I'm a spreadsheet nut, a nerd. So I eat that stuff up all day long. I tend to tell people or advise, investors that, hey, listen, these are the few things that you want to pay attention to. And one of the most important ones, in my opinion, is the debt service coverage ratio. It has to be, for me, that's one of the ones that's near the top. When I look at a deal, because it's going to tell you about the health of the deal. So the short version of what this is if you have a debt coverage ratio of 1, that means you have exactly enough profit or rent to the property to cover your debt service. And if it any higher than that, say if it's a 1.2, 1.3, which typically is what lenders are looking for, is about a 1.3. So if it's a 1.3, then that means you have 30% higher than your debt service. And so I tell people to focus on that. How does that look year on year? And then what's the change? What's driving the change, to make sure it's an actual real change behind it, not just something on a spreadsheet. But I focus very heavily on that. And and going back to the value preservation, conversation, that's another thing that you typically see that is inherent to a highly valued, a quality deal, is it typically has a very, very healthy debt service coverage ratio. We're talking like in excess of 1.6 to 1.7. It's the deal that we recently closed had over 2. Okay, so that's one thing that I focus on, because when the economy changes and you're in a scenario like what we're seeing today, you still have a deal that will cash flow. Okay, I mean, that's the problem that a lot of us are seeing right now in the market, is that deals are not cash flowing. And so if you have a very, very, very healthy debt service coverage ratio, that's a real, it's really backed by some real assumptions and some work, then you feel much more comfortable in that deal. Okay, if nothing else, you feel comfortable that the deal can help you last through and push through kind of the things like we're seeing now, which is a temporary kind of downturn, and then you come out of this, come out on the other side, and you're in good shape. So that's what I would say is probably the most important metric that I think investors should pay attention to.
You shared a ton of gold nuggets on the velocity of capital and also just investing in general. Do you have any final advice for investors looking to leverage the power of the velocity of money in their own real estate investing journey, and any like personal valuable tips that you've picked up along the way on your own investing journey?
Sure, sure. So I've been a limited partner, a passive investor in 11 deals, and I'll tell you that one thing that I kind of wish I'd have done is when I find a deal that I like the team, I know the market, and I look at this deal, the property and everything, I really like the deal. Um, I would have put more on fewer deals. Okay, now I said that because there's some deals there for me which is absolutely home runs. I'm not against diversification, but what I'm saying is once you have a thesis and you know that this deal fits it, and if you have the capital, um, I would caution people from defaulting to I want to diversify just for the sake of diversification. Okay, if you have a couple of deals that you're looking at and one of them really, really is speaking to you and it makes a lot of sense, you know the team they've performed, then I would say don't be afraid to double down on that deal. That's my own personal experience. I'm not trying to give any risky advice. Still, make sure that you value the merits of the deal, all that, the team. But that is something that I would have done personally. Yeah.
Yeah, you mentioned having your thesis, and it might have just been the choice of words, but I really like that concept of like identifying your own investment strategy and how what you want your investments to do for you. Can you expand briefly on how you chiseled down that thesis and maybe how you incorporated the velocity of money philosophy to that to make sure that the investments you were putting your money into aligned with it?
Yeah, sure. So for me, I started with the end in mind, and I knew that first of all, I wanted to do this full time. I wanted to make sure that at about the 5 year mark, that I had a good healthy bit of the capital that I deployed. I wanted it to double within a certain amount of time, and so that's how I started. I basically said, well, where do I want to be, and which of these opportunities? Because at that time, I mean, we were getting. You remember, like a couple years ago, there were just tons of opportunities. There still are, but just it doesn't compare to what it was when the transactional volume was higher. And so, at that point, I said, well, okay, which of these deals is going to help me achieve that goal? So for me, the velocity of your capital is very important. But what's really important about it is that you can actually map it out. It's not like it's this mystery that you can't do anything about. So I was able to say, okay, here is my target, here's my goal, and which of these opportunities will help me get there, so that I can then increase the velocity of my capital relative to kind of spreading it all out, and then having something that I'm banking on, that I really have no, it's somewhere in the future, something like that, instead of me looking at what can I do today to make sure that I reach my near term goal. And so that was kind of what I focused on. Sure. First of all, they can go to, well, thank you actually first for having me on this show. I think you guys are amazing. First of all, my website is Birch Prosper. So www dot birch Birch and then Prosper prosper.com. You can email me. I'm at Brandon.Jenkins at Birch Prosper. That's Brandon.Jenkins at birchprosper.com. I'm also on LinkedIn. I'm pretty active on LinkedIn. Brandon Jenkins, I know it's pretty common, but but I'm on there, and Instagram as well.